financial liability or is an equity instrument. So two key points to summarize from what everyone has spoken. The first one, it has to arise from a contract. And I think that is one of the most critical points that we need to keep in mind. Because some of this could have a direct impact on how we present our financial statements. So in a lot of cases, when we implement Ind AS or when we audit Ind AS financial statements, items like taxes or advance tax paid, while yes, there is a right, or well, there is a situation where you will receive cash in the future to settle that receivable, but it does not arise from a contract. So therefore, any statutory dues, any items that do not arise from a contract are not within the scope of financial instruments. So very important, it's that it arises from a contract, and that's something that we picked up very well on the chat box also. So if you want to look at the definition, it's arising from a contract, and naturally there are two parties to an instrument. For one party, there has to be a financial liability, and for another party, there has to be a financial asset. Let's take some of the more commonly understood examples and then we'll go into the definitions. Suppose there is a company that has issued a debenture and I am an investor in a debenture, right? So because I am an investor, I have an asset, which is a financial asset, and I have a counterparty for whom it is a financial liability, right? So two parties are required, and let's not forget, debenture is also a contract. It arises out of a contract, not out of law. There is a law that governs rules around how debentures are to be issued, but that's not the contract itself. And a very important point to keep in mind is when we assess or implement this standard, we only cover those items that are in the contract. You do not bring in elements that are not in the contract into our analysis. And I'll come to that when we talk about an example later in the day-to-day. Park that statement with you. Do not bring in things that are not in the contract in your assessment. Only look at the assessment of what is there in the contract. Another simple example is investment in equity shares. Let's say there is a company called ABC Limited. I hold shares of ABC Limited. For me, it's a financial asset. Whereas for that company, they have issued equity capital. So this is basically what the entire definition of a financial instrument looks like. Two parties to a contract, to once again summarize, it has to arise from a contract and only look at what is there in the contract to conclude the assessment. Now let's dig a little bit deeper.